Well, it's not often that we have one of our colleagues from Singapore joining us on the podcast, which I think says more about my willingness to either stay up late or get up early. But this is a real treat. And when we're here to talk about the emerging markets portfolio, but before we do that, I wonder if we could just spend a moment to introduce you, given it's your first time on the podcast. What was your journey investing wise, and how did you come to more?
Sure, happy to share. So I started exploring investing, at 17. At that time, I built up a $1.2 million portfolio, had an unaudited 8-year track record of about 20%, all this while still a student.
Wow.
I did lots of small cap stuff then. So at that time, I set up what seemed like a business facade, actually, to interact with company management teams who were most of the time taken aback, having seen me in person, especially around 17, 18, very youthful face. And it was actually quite funny. But I would say this early experience actually sparked my passion, curiosity, perseverance, and lifelong ambition to want to become one of the world's best investors.
When you still look quite youthful, credit to you. What about more? How did we cross your path?
Interesting story. So I have very generous friends, and one of my generous friend saw the posting on CFO website. Immediately, he sent me a text message, say I would be, it's a great, wonderful company. And then I did my own homework, basically looking at two things: investment philosophy, and that aligned, like a glove with what I do. And the second will be culture. And I did Glassdoor checks. I spoke to employees in the firm, and upon these two criteria, I applied. I'm blessed to have been able to join the company, and I think turning this passion I have into my career, I find immense joy, lots of energy at work, and I think I'm experiencing what Buffett coined as tap dancing to work. Awesome experience.
Fantastic. Well, we feel that too, Wen. We're certainly glad that that you joined us. You talked about, when you're running your own portfolio, I think you said at the age of 17 or 18, you were finding lots of opportunities in smaller cap companies. And of course, as listeners may know, our emerging market strategy is one that is genuinely all cap. In other words, we are looking for companies that meet our philosophy, regardless of their size and where they are in the world. But there is meaningful exposure to small caps in the portfolio. And I'm wondering just, how much of that is your influence, just given your background? And why do you think that's so important in constructing a great emerging markets portfolio?
I think the key thing about smaller cap companies is that it's just a pond whereby there are just fewer rods. And with fewer rods, it's not only intellectual stimulating, but you just find opportunities from time to time. But it's hard work. You have to work through and turn over stones. But that being said, I think the beauty about it is there's investment opportunities everywhere. Large companies are good, steady Eddie businesses with established competitive advantages. And then you have these small mid-cap companies where you can juice up returns for the portfolio as well.
Well, great. And I hope we have a chance to speak to one or two of those companies a little bit later. But can I start just on a topic that's been quite influential, both at markets at large, but certainly for emerging markets investors, and that's semiconductors. Certainly a wild ride with respect to stock prices over the last couple of years. Geopolitics, them playing quite a significant role in driving some of those, or playing a role in some of those tensions. Can you summarize what's been happening, both in terms of the fundamentals in the industry as well as the stock prices?
Interesting topic. So I believe the slump in 2023 was driven mostly by post-pandemic demand normalizing and macro challenges leading to inventory destocking cycle. So what changed since then? And I would sum it up in 4 key buckets. The first one is that we have industry capital and operational discipline actually playing out, given that the industry has actually consolidated very much over the decades. The second bucket will be real demand acceleration caused by increasing AI applications in the market. And I think it's arguable that this may actually usher in a new era for semiconductors. The third bucket will be intensifying geopolitical landscape, which you rightly pointed out, which is driving diversification of supply chain, hence more equipment demand or overstocking by China. And lastly, the three factors combined actually, I believe, radically led to a change in investor sentiment, especially from a year ago when everything was looking bad.
Absolutely. And in terms of the portfolio, TSMC, obviously the top weight, and I think hits a lot of what you just talked about in terms of really being one of the drivers or the beneficiaries in that consolidation, just others not being able to keep up. But what other exposure do we have across the portfolio?
Yeah, so we have several direct or indirect exposure. We have companies like Lino in Korea who offer test pins and sockets that are actually essential consumable items used in the R&D stage of mobile chip testing. We have Samsung. I don't have to elaborate much about that well-known company. We have Kinik. This is a rather new initiation. It's a Taiwanese semiconductor consumable player. We also have FPT Corporation. It's a Vietnamese conglomerate with a rapidly growing low-cost IT services business that focus on new age digital transformation projects.
Can you talk a little bit more about Kinik? Because I think it is one of the more recent additions to the portfolio. How did you come across it? What kind of work did you do? Presumably, they work closely with existing holdings like TSMC, and how did that inform your analysis?
Good question, because let me just take a step back and talk about the three avenues where I usually find ideas. The first one would be more brute force screening, when I go through company after company, reading the pair sheets and their respective business models. And secondly, just reading widely trade journals, attending conferences, speaking to great sell-side analysts, or other creative channels. And the third one is speaking to other good buy-side investors. And for Kinik, I wish I can claim all the credit for myself finding this, but this company was actually brought up by my trusted friend. And after I had completed a very deep dive analysis of the company, we decided to add this into the portfolio. And the most interesting thing about Kinik is its dominance in a consumable used in chip manufacturing called diamond disc conditioners. And it's quite technical. I don't want to bore you with the technicalities, but the key thing to take away is that as process technology gets more and more complex, Kinik actually benefits, the consumable actually benefits from a higher pricing because of customization that's required, more frequent usage, and a quicker replacement cycle. So they do benefit from the current trend towards leading technologies. And the beauty as well is that Kinik in the past, they used to have 30-40% market share, but in the leading edge technologies, in the 3 nanometer process nodes and 2 nanometer, they have anywhere from 70 to 80% market share. And we believe that this advantage is sustainable given patents, technical barriers, very importantly, very close and trusted customer working relationships, especially during the R&D process. And another important factor is that it's a very low cost product, but this will cost the company a lot more if they switch it up for a slightly cheaper product, and
right, just not worth it.
Just not worth it.
Not worth the risk. Yeah. Well, great to see the trusted friend or generous friend network strike again there with respect to helping you out with that investment idea. Shifting gears, and perhaps this played a role with Kinik, but one of the questions we often get from clients, just with respect to the emerging markets space specifically, is just, okay, we get that you're a bottom-up manager looking company by company, but surely macro considerations must play a role or a more heavy role in the emerging market space. Can you speak to what that looks like in terms of managing or putting together this portfolio?
I have a slight macro overlay, but the key essence here is that we make decisions for the entire portfolio entirely on a bottom-up basis, and then we just add a slight macro overlay. But I think I would like to speak with regards to one, more important topic of macro, which is geopolitics. I think that makes investing a lot trickier, in my opinion, especially because I believe this risk, has binary probabilities and outcomes. But our stance is to prepare, not predict, not swing to the extreme end. So having 100% weight in China or excluding, China/Taiwan, but take a more middle ground approach while having a higher hurdle rate in terms of business quality, management teams, and valuations. And Kinnick is actually a great example of that because I think it fits all three buckets really well, and valuations look attractive at the time when we purchased it, and therefore we didn't exclude it just because the risk of geopolitics it's high. Right? So we are constantly open on the mind on the hunt for great opportunities, and we do see great companies, wonderfully run companies at good prices. So stay tuned.
On that subject of great companies at great prices, the portfolio has done remarkably well over the last 18 months or so. Can you talk a little bit about what's been driving that?
To achieve differentiated results, we have to be different and many times the intangible aspects are often overlooked. So I'll just spend a little bit of time talking about intangibles, which is team culture and candor, and that allows us to operate a nimble, high trust, and high performing team. I think candor is important when voicing dissenting opinions, and also we actually provide this safe space to admit mistakes when things don't go according to plan. So we accept errors from time to time, and this safe environment actually gives everyone the courage to act on good ideas. I think that's really important. Now, secondly, on process, we run a relatively more concentrated strategy. Today, we have about 40 names, and the top 10 names account for about 40%. So this means we have fewer resources spent monitoring and maintain and doing update reports. And this gives us actually more time to look for new ideas. So, and even for our update reports, we prioritize, very concise analysis of key insights only, and that frees up, more time to hunt for new ideas and building our inventory list. Therefore, our team, spends a lot more time to turn over stones globally, and more importantly, I think we earlier discussed choosing to fish in ponds where there are fewer rocks. And today we have about 85% of the portfolio in non-index names. So that's on the more intangible front. And on the more tangible front, looking at portfolio attribution, I think EMEA was a majority of the reason for our performance. We did find very well-run, super quality business with good, very attractive valuations. For example, Kaspi in Kazakhstan, Salik in the UAE, BCG in Baltics, Dino Benefit Systems in Poland. So at that time, these wonderful companies were priced attractively given the geopolitical uncertainty in that region, and to a smaller extent, LATAM and Asia. So we do have stocks that did really well, like FPT in Vietnam, XP and GPS in Brazil, and PetroRio in Brazil as well.
Okay.
But I would just add a caveat that this geographical mix isn't planned and deliberate. We make our decisions on a pure bottom-up analysis, and these stocks were added into the portfolio.
Well, I was going to say, it sounds like the contributions to the portfolio's performance over the last little while have been quite broad and quite company-specific as well, which is, it's really what we want to see, given the way that we approach investing. Before I let you go, and before I let you go to bed, what misconceptions do you think that North American investors might have about emerging markets, or that we might underappreciate about the opportunities in the space?
Yeah, I think several misconceptions. I think the first general one is that, the EM space, it's a difficult market. And yes, it is a difficult market, but that is where we make money by working hard and working smart. And a lot of it has to do with EM, as a whole, having a bad rep for corporate governance. So investors might treat the entire emerging markets as a monolithic entity, but in reality, the EM space is actually very diverse. So there's wide inequality, and just by identifying great management teams, you can make good money. And in fact, some of these EM markets, they are just as professional as DM in the DM space, developed market space. And what makes it better is that there are, better management incentives because most of the companies in EM tend to be more founder-run companies. So from what I can think of, such markets tend to be in Taiwan, Poland, Brazil, etc. Another misconception is that EM business quality is generally poor, and that is true to some extent because in the EM space, a large percentage of companies are commodity companies, banks, agriculture companies, and those low value add manufacturing. Right? So, but what I'll say here similarly is that it's really diverse. So if you spend time to dig, there are really interesting companies, quality businesses as well. So I think all in all, great space to be in, lots of opportunities.
Well, and it sounds like you are perfectly placed given your passion for the hunt. And so thank you so much for joining the podcast. Hope to have you on again soon.
Thanks, Rob, and thanks everyone for listening.